Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering Form 1098Q, which provides information on qualified longevity annuity contracts. At Spidell's 2024 post-tax season update and review webinar, you'll get answers to all of the questions that pop up during tax season and more. Topics covered include ERC audits, research credit developments, and Secure 2.0 Act changes going into effect in 2024. Get registered at one of 4 dates in May at spidell.com under webinars. Form 1098Q, Qualifying Longevity Annuity Contract Information, is an annual information statement prepared by the issuer of a Qualified Longevity Annuity Contract, or QLAC. Now that interest rates are much higher than they were even 2 years ago, and the fact that the Secure 2.0 Act increased the maximum allowable QLAC investment to $200,000, more taxpayers are investing in them. Form 1098Q is very similar to Form 5498, IRA contribution information, which is issued annually by the trustee of an IRA to its owner, which contains helpful information for taxpayers and tax professionals, such as the fair market value of the IRA for purposes of calculating RMDs, or the taxable portion of the IRA distributions where basis is present. Form 1098Q provides the taxpayer with the annuity's start date, the amount of the taxpayer's monthly annuity on the annuity's start date, whether the annuity can be accelerated to a date before the annuity's start date, the total premiums paid for the annuity, and the fair market value of the annuity as of December 31st of the reporting year. The monthly annuity amount and its start date are helpful for income and estimated tax planning as the taxpayer gets closer to the annuity start date. Knowing whether the annuity start date can be accelerated can be helpful for taxpayers that need to access their money sooner than the annuity start date. This can come into play if the taxpayer cannot wait until the start date to access their money. Knowing whether the taxpayer has maximized their QLAC contributions can help determine if additional QLAC investments are an option. Taxpayers can move up to $200,000 from their IRA into a QLAC. If the sum of all QLAC contracts owned by the taxpayer is less than $200,000, then the taxpayer can still make additional QLAC investments if they want to. QLACs are investment vehicles that allow taxpayers age 65 and older to remove assets from their IRA and hold them until later retirement years. A key benefit of the QLAC is the removal of RMD requirements for assets placed in a QLAC. QLACs make it easier for retirees to address the risk of outliving their assets by using a limited portion of their retirement savings to purchase a policy in a retirement plan that will provide guaranteed income for life starting at an advanced age. Distributions from the QLAC are required to commence no later than age 85, although the contract may specify an earlier age. The premiums paid for all QLAC contracts for the benefit of any individual cannot exceed $200,000, which will be indexed for inflation starting in 2025. QLACs can be purchased under defined contribution plans, traditional IRAs, IRC Section 403 subsection B plans, and governmental IRC Section 457 subsection B plans. QLACs cannot be purchased with funds from an inherited IRA. We covered this topic in a recent issue of Spidell's Federal Tax Letter, a monthly newsletter plus searchable online archive of back issues that keeps you at the leading edge of federal tax issues that impact your clients. You can get more details and subscribe at spidell.com under Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.